to start. This is the New York Fire Department Pension Fund investment meeting. Today is 10/19/2011. It is 10:13. We are at New York City Controller's Office, 1 Center Street, room 530, New York, New York. Can we have a roll call of trustees?
Roll call of trustees. Ms. Ranjini Nagaswamy.
Present.
Mr. Larry Schloss.
Present.
Ms. Janice Emery.
Present.
Mr. Stephen Cassidy.
Mr. Slevin as Mr. Cassidy's proxy.
Mr. James Levin.
Here.
Mr. Robert Straub.
Here.
Mr. John Kelly.
Leroy McGinnis as John Kelly's proxy.
Mr. James McGowan.
Here.
Mr. John Dunn.
Here.
Mr. James Lamonda.
Mr. Dunn has Mr. Lamonda's proxy until his arrival.
Mr. Sean O'Connor.
Here.
Commissioner Douglas White.
Here.
We have 24 votes in a quorum. We can start the meeting.
Okay. With public agendas first. Performance reviews, Larry?
Okay.
What was the last thing you said? Something for you?
I said performance reviews, Larry.
Thank you.
I'm referring to Larry. Yes,
Just give us a courtesy reminder when we're live on the cameras, please.
we're live now.
Thank you.
Okay, I'll tell you when the cameras will supposed to be on until we go into executive session. All right? Okay?
Okay, I'm Larry Schloss, Chief Investment Officer. Rather than bang through the slides on the economy, I think everyone's read enough in the papers that the economy is drifting downward. All the slides point to downward. The primary reason for the downward is what's going on in Europe and the euro and the bailouts of the sovereign debts. They're supposed to be worked out literally over this weekend. I wouldn't hold your breath for this weekend, but I like to think good things come from the weekend, but I have a feeling it won't be everything all wrapped up in a nice bow. If you take that and combine it with the super committee that's at work in Washington, which is supposed to deliver its $1.5 trillion worth of cuts on November 23rd, the combination of those two has led to a reasonable amount of gridlock. Gridlock
Larry?
being, yeah.
Excuse me, the reporter did.
Gridlock. Gridlock being because in the U.S. the tax code is up in the air. Some companies are holding back investment dollars. They have a lot of cash in their balance sheets. Consumers aren't quite sure what their tax rates are going to be, so they've pulled back a little bit of spending. And in general, the economy is slowing. As we know, the Fed came out with Operation Twist, which is trying to get long-term rates down, having successfully gotten short-term rates down with QE 1 and 2. The impact of all that is on page 21. And on page 21 you can see the VIX. The VIX has bounced around. There's a lot of volatility in the markets. There's a lot of volatility in the stock market, in the bond markets, and confusion as to which way things should go. And it's very hard to make short or long-term investments of any consequence in the current environment. On page 22, the white line is the current yield curve. You can see, again, it's the short end is down and the long end, the Fed's working on getting the long end down. And I'm confident they'll succeed to the extent that they're going to succeed once you get through people coming in and out for safety reasons because of the two factors I've just mentioned. If you look on page 23, you can see the 10-year rate. It was down as low as 176, I think, which is sort of a ridiculously low rate for a 10-year security. It's now north of 2 again, about 215, 220. Again, the Fed's going to be working on keeping that rate down. On page 24, you can see the spread of high yield has gone way up from where it had been. Again, it's sort of a risk-off trade. People are worried. They sell things that have risk, perceived risk, like high-yield bonds. Next page, 25. This is the S&P 500 versus the PE of such. And you can see earnings are going up. The market's basically come off, so the PE is down. Stocks are getting cheaper. Having said that, if you look on page 26, you can see corporate profits in the blue line are doing very, very well. It's earnings season. My guess is you'll have some mixed earnings this quarter. And again, people are waiting for this quarter will be very important sovereign news between the U.S. and the sovereign countries of Europe. Moving on to page 27. This is small, medium, and large cap. I'm sorry, this is U.S. markets, EFA, and emerging market indices. Again, prices look reasonably cheap. As soon as things calm down, I'm sure I'm confident the stock equity markets will go up. Similarly, if you go on page 28, you can see large, mid, and small cap. I think that the PEs on next year's earnings are probably overstated because the people have not readjusted their earnings downward yet. So they probably look a little too cheap, but again, they're reasonably inexpensive. If that said, if you look on page 29, basically since August, you see this sawtooth pattern that has developed between the market hearing something good out of Europe and hearing something bad out of Europe. And it's in this range, particularly the white line is the U.S., but it's sagging a little more, particularly in emerging markets, which is the red line. But again, news should perk it up one way or the other. If you move forward to page 31, you can see the fire portfolio is down to about $7.6 billion. We ended the year around a little shy of $8 billion. So as much as we're off the peak, we're actually not down that much for the new fiscal year. You can see it monthly on the next page. Again, we're up significantly in the last 12 months, but off the peak. That gets the asset allocation on page 33. As we've discussed in the past, we sold high yield, we sold some equities, we took a little off of fixed income as well, so we have a lot of cash. The cash is some combination of taking some risk off because the markets are just too unpredictable, and setting up for this new asset allocation, which we approved June. In June, shortly we're going to go through the rebalancing ranges, and then we'll come back with the IPS that goes with the new asset allocation as well, and have it all hopefully wrapped up by the end of the year. But having this cash, once the market stabilizes, we can go ideally from page 33 to page 34, which is the new asset allocation. Again, you don't do this over a weekend. It'll take us probably 12 to 18 months to fully execute it, but we're well underway, as you all know, with the opportunistic fixed income, which I think is pinkish, but maybe that's chartreuse. And Martin, I'd say we probably committed half of that amount that we're under allocated now. Maybe more. So that'll come off. Similarly, the hedge fund SEMA is working on. We're going to bring something probably in December for hedge funds, so that'll come off as well. And we've reduced equities, U.S. equities, so that's down. So again, we're in the process of rejiggering this. We'll come back to you after we get the rebalancing ranges with the rollout of the plan. But again, we're a little hampered by the volatility in the markets right now. Okay. 35 is the numbers that goes with those pie charts. 36, you can look at the month of August. In fact, let's go one page further before I go to that. If you look on page 37, August was really when the volatility came into the market. So if you look at the top part of page 37, U.S. markets were down at the beginning to the end of the year about 7%. International markets were down more, probably 8 to 9%, and the high yield markets started to back up. If you go one page further, you can see it really accelerated into September, on the end of September. So on 38, if you look at the top piece again, some of these markets were down 10 to 15%, the two top blocks of equities, and again, the high yield market again backed off. So it's been a very, very difficult time to make long-term investments on the one hand. On the other hand, well, not long-term investments, it's a difficult time to begin our asset reallocation. So if you go back to page 36, given all that volatility, we actually didn't do so bad in August. We're down 4% for the month. For the fiscal year, we're down a little bit less than 5%. The beginning of October has been one of those sort of down and then back up. So I think we're down a little bit off of where we are now. But again, we're just going to have to see what happens in Europe. That is really going to determine how all the markets move, and it'll probably start next week and the week after. So I'm sure by the next meeting we'll have completely different numbers one way or the other. And I don't have a crystal ball to say how it comes out. But again, it was driven by the equities. We made a little money in fixed income. That's really it, other than the individual manager reviews. Do you have anything you want to talk about fixed income managers?
I have some specific manager information that we'll talk about in the executive session.
SEMA?
Just one thing on Aronson Johnson, large cap value. We just need to get your approval to extend their contract for a year. Their contract is up at the end of December, and we're
Speak up, please.
Hold a second, just a second. Larry asked a question. Won't you ask it again so the reporter can hear you? Larry?
Sorry. Is there anything you'd like to talk about? What was that? Equities.
okay. No, sorry.
Okay. Barry?
No.
Yvonne?
No.
Anyone with any questions on the performance of the month? Okay, great. So the second thing on the public agenda is the asset allocation rebalancing ranges. And I'll turn this over to you.
Sure.
Yeah.
I am Kristen Finney-Cook from NEPC. Last meeting, it was requested that we discuss the rebalancing ranges. We provided a memo in your board book. It's page 60, right behind asset allocation. What we've done is broken down all the asset classes into the various buckets as it relates to the new policy targets. We have also included the current allocation as well as the rebalancing ranges. Some of the rebalancing ranges are a little bit larger as we are looking at moving the portfolio into the various asset classes. Obviously, the movement doesn't happen immediately, so some of this is going to take some time. And wanted to know if you had the opportunity to review, if you have any questions. On the bottom part, we talk a little bit about where some of the unallocated assets are going to be placed. So as an example, for opportunistic fixed income, we would recommend the unallocated category be split 25% in cash, which would be 1%, 25% in core plus, which would be 1%, and then 50% to domestic equities, 2%. And again, this is just the interim until we're able to get into our asset allocation fully, which could take, as been stated, anywhere from 12 to 18 months. For real estate, we have the same type of strategy. The allocation, unallocated amounts go to 50% to core plus 5 and 50% to global REITs. And again, this is unallocated as we're looking to move into the allocation. So this is embedded. These are actually embedded into the ranges. Private equity, the uninvested capital would be 75% to domestic equity and then 25% to international equity. And then hedge funds would be split 50% in cash, which would be 2%, 25% to international equities, and 25% to domestic equities. And so that gives you also an idea why the cash is a little bit higher, because there are some of the unallocated asset classes that are sitting, those assets sitting into cash.
So I guess, go ahead.
I was just going to say that this is obviously our first draft. If there are any comments or feedback, we're happy to take that under consideration, but we wanted to have something for discussion purposes as we look to ensure that we are within policy.
So I guess 3 separate categories of questions. First, on the rebalancing mixes that we're thinking about, I think our sort of thinking is that it would be better to simply acknowledge that we are in a massive transition and not have a policy target that is sort of about the transition. So the policy should be just steady state. And so instead of equities being 23 to 42, the question is what should be a steady state allocation, plus or minus 3%, 4%, like we have now. And then an interim target that simply acknowledges that we are in transition. So I'd rather have the investment policy statement be clean and then have an interim target, like we've talked about with BAM, that just acknowledges that we are in a pretty significant shift in the current period. So just something to think about and come back on. And I can, any questions, please come back to me. The second is the investment policy statement today very specifically has rebalancing ranges for the broad risk buckets. So equities, total fixed income. And I think as trustees, we should be less concerned. In other words, we should give BAM more discretion.
You say BAM? Yeah.
BAM, yes. That's the Bureau of Asset Management. Hear that from me a bit. We should give BAM discretion within buckets because going from small cap to large cap doesn't change the overall risk of the portfolio, but tighter bands across equities and fixed income because that's and cash because that significantly changes the risk of the portfolio. So if you think of our policy mix, the most important decisions we make are 70-30-0, equities, fixed income, cash. It's not international versus US because the volatility and the risk doesn't really change that much. So as trustees, we should be much more aware and thinking about the overall allocation to the risk versus the income buckets. And I'd be willing to give BAM more discretion within the buckets. So while it's in the investment policy statement, it is not in your rebalancing recommendation. So I'd like to suggest that we group these as we have them in the investment policy statement and then address as a board sort of the broader categories more thoughtfully than we might the subcategories.
You say discretion.
Well, you can think about
Investments?
No. The rebalance, just the rebalance. So it's to say, look, today maybe in international, for example, we have a plus or minus. If you take the 10%, we have a plus or minus 2% to IFA. All right, that seems a little tight to me. There's no reason for BAM not to be able to go. I'm making this up. We need to study at 4 to 5% for IFA, plus or minus, as long as the overall equity is maintained within a plus or minus, let's say, 3% type bucket.
So what you're suggesting is if we were at the minimum for all of the public equity allocations, the total equity would be at a point that would not be consistent with the asset.
Right. So this is a very important point. I haven't done the math here, although I can add it up 22, 31, 35.
That's not right, Martin. If you're at the bottom of each individual range, you'll be through the bottom of the
This is
total
my
equities.
concern.
That's right.
Right.
So let's just
So
take...
she's right. She wants a minimum constraint when you add it up. Less
For
concerned
total
with
public equities.
Right. Less concerned with the individual line items, but you can't. If you end up at all the bottoms and you're through the bottom of total equities, that's foreboding.
Right. So if you take the policy targets, 29, 10, 6.5 to the first three categories, and I'm just keeping this simple, so bear with me, that's about 45.5%. Let's say 45%. But if you take the proposed rebalancing, 23, 8, and 4 gets you to 35%. So within our guidelines, if you ignore the investment policy statement, which we shouldn't for total equities because there is a bucket there, we could theoretically go to 31% in equities and we'd still be within policy. Well, that's not what we want.
Right.
So it's the total numbers that we need plus or minus bands so that the risk profile doesn't change of the total. and allow greater discretion within the bucket. So when we come back and see this, it will become a lot clearer, because that'll say that overall equities can't be more than, let's say, 42, 48 or something like that in the long term. So it's just how we group these, as we do very clearly in the investment policy statement, but it doesn't show up here. So that was the second observation. The third observation is we should, as a board, be very careful to think about cash. Historically, you've all heard me. I've been very anxious that, as a board, we have equitized our commitments in the illiquid categories. In other words, as we were waiting for real estate and hedge funds to get invested, we used to put it in private equity to get invested. We used to put that all into equities. That's a big bet. And if you remember, 6 or 7 months ago, our equities were significant, even higher relative to our policy portfolio, because we were equitizing our cash. So we have to think as a board, with NEPC's help and BAM's help, what we want that cash policy to be. So they've spelled out a bunch of things. I actually don't know how, Martin and Larry, you implement all of this. I don't know how you go in and out of global REITs. So please help us think about if you have any implementation issues, or if you've gotten enough toolkit options to do
We
that.
have the toolkit. That helps a lot.
But the other way of thinking about the cash is to say, as a board, we agree that we we have discretion not to invest the next 12 months worth of commitments, because quite honestly, if we go into equities and equities go down 40%, we still have committed $100, not 60 cents on the dollar. Where are we going to? We have to rebalance to come up with that cash. So I want us to be a lot smarter about how we invest our cash, or how we invest the money that we have committed, but that has not yet been drawn down by the managers. And in this transition, that's a big amount. That's a lot of cash. That's a lot of dollars moving into hedge funds and opportunistic. So as a policy, we are very clear that we do not have an allocation to cash, that the maximum for liquidity purposes is 1%. We are in cash in part because of the new allocation. I am not in favor of being in cash because of prudency. I think we need to have that conversation as a board. I think if we are worried about the markets, and BAM is worried about the markets, one would actually buy bonds, not cash, so we should talk about it. Are we set up to make these valuation calls on the market? I have concerns about this. So when we come back, we should address those three big issues, which is how we categorize the buckets, equity, fixed income, and cash being the most important. How we invest the cash while we wait for these commitments, and what to think about cash in terms of what we require BAM to work with us on before they make policy changes, because technically we're outside guidelines even as we sit here.
Well, we're going to come back to everybody with an IPS. That's probably the best way to address it all. Through the IPS document, go through it, have a conversation about the policies, and then have an IPS that has a new asset allocation, new rebalancing ranges, and then implement. So we're kind of in process.
Yes.
Kristen, would you briefly explain why it takes 4 to 8 quarters to do the funding? And when you say hedge fund, do you specifically mean our Permal investment or future hedge fund investment? Future, okay.
Not any one investment.
And why does it take 4 to 8 quarters to fund?
Because we want to see the managers. Thank
Because
you.
what? I didn't hear you.
Because we want to see the managers. I'm being naughty here a little bit.
It's
But
really,
Larry, over to you.
Well, first of all, we have funded all the Permal.
I'm sorry, Larry, what was it?
We funded all the Permal, just to sort of.
I'm still not hearing you,
We
sir.
funded all of our investment in Permal as of August.
100%. 50 million, 100%.
Yes,
Okay.
it's all funded. And it's actually done well. You want to give a quick update on Permal before I address the other things?
Now that's,
Okay, never mind.
Yeah,
So we have that.
Should that be in the executive session, Larry?
Yeah, okay, we'll do that in executive session. So we funded that. That leaves the biggest chunk of the allocation, which SEMA is working on diligencing the managers with Axiom. You'll recall that we'll probably end up with a portfolio of what's called 20 managers. So it takes time to due diligence 20. I think in December we'll bring 4. So if you assume 4 once a quarter, let's say, that'll get you 5 quarters worth, 4 or 5 quarters worth. So I think that's where the 12 to 18 months came from. So we'll slowly be bringing managers to the board. That was your comment. So you'll meet the managers. It will take time to meet all these managers. And as we do that, per this guidelines, we'll have the money invested in these specific areas, waiting to be invested in hedge funds. It's the same thing with the opportunistic fixed income. We've approved some managers. Martin and Addie are documenting it, but we haven't invested any of the money yet. Once we get it documented, then they'll slowly take the money down. Maybe not so slowly, but they'll take the money down probably over 6 months. So there's a bunch of stuff that's in process. And to Ranji's point, where do you put the money in the meantime? These footnotes are the guidelines as to where you're supposed to put it, subject to markets and subject to implementation of the other stuff we have going on. But those two in particular are all very diligence, manager sensitive, and BAM's working on. Does that answer your question on the timing? It's just sequencing. And again, our vision, assuming the market just calmed down a little, I think that the cash number will go back down to about 0 by the end of the fiscal year. You just calm this market just a little bit.
You're speaking under your breath, sir. It's hard to hear you.
Okay. I said we should have the cash fully invested by the end of the fiscal year, with a little help from the markets. But we'll come back to everybody with the IPS to answer all 3 of those questions. All 3 of those questions by end of June.
By end
No.
of-
By end of the year, we'll have the IPS calendar year. That's 2 months. That's 2 months. Okay. So we have a homework assignment on this rebalancing. We'll keep going back to the total equity, total fixed income. All right. Any other questions on the rebalancing?
yes.
Good to go? Okay. That ends our agenda for the public session.
Okay, we need a motion to move out of the public session to the executive session.
So moved. Second.
Any objections? Here are no objections. The motion passes. We're in executive session now?